Every major financial crash of the last 100 years followed the same pattern. Not a similar pattern, the same one. 1929 followed it. 1987 followed it. 2000 followed it. 2008 followed it. And the most uncomfortable part? This pattern appears months, sometimes years, before the collapse actually happens. Wall Street knows it. Central banks know it. The people managing money for billionaires definitely know it. But most people never hear about it. Because if they did, they'd exit early instead of late. Today, I'm going to walk you through all 5 stages, and I'll show you exactly where we are right now. Spoiler, we're much further along than most people think. In 1929, an analyst named Roger Babson stood on a stage and said 9 words that made him a pariah on Wall Street. Sooner or later, a crash is coming. And it may be terrific. He was mocked, ridiculed, dismissed by the top economists of his time. 47 days later, the market collapsed. Babson wasn't guessing. He had a framework, 5 stages that repeat every time a financial system breaks. Let's start with stage 1, the credit explosion. Crashes don't begin with fear. They begin with debt. Before every major collapse, borrowing grows faster than the real economy. People use cheap credit to buy assets. Rising prices make them feel richer. Feeling richer makes them borrow even more. In the 1920s, ordinary workers borrowed 90% of the money needed to buy stocks. In 2007, it was mortgages with no income and no down payment. In 2000, it was corporate debt backed by inflated stock prices. Today, debt is everywhere. Margin loans, portfolio lending, options leverage, corporate buybacks, and government deficits larger than the defense budget. As a share of GDP, total US debt is higher now than in 1929 or 2008. Stage 1 isn't a warning anymore. It's already burned through the dashboard. Stage 2 is concentration. Crashes don't happen just because prices are high. They happen because risk becomes concentrated. In 1929, a handful of glamour stocks dominated the market. In 2000, it was a small group of tech giants. In 2008, it was a few banks holding most of the system's risk. Today, the top 7 stocks make up roughly a third of the entire S&P 500. That means millions of diversified retirement accounts are actually making the same bet. Passive investing amplifies this. Money flows into the biggest names on the way up and is forced out of them on the way down. That's the concentration trap. Stage 3 is the smart money exit. This is where the game becomes visible. Before every crash, insiders quietly sell. Executives reduce exposure. Institutions hedge. Publicly, they stay optimistic. In 1929, elites sold months before the collapse. In 2007, insiders dumped shares while telling investors everything was fine. Today, insider selling is near historic extremes, while retail investors continue buying at record levels. That gap has never closed gently. Stage 4 is the liquidity illusion. Everything still looks normal. Markets are high, volatility is low, but underneath, liquidity is draining. When liquidity disappears, markets don't fall smoothly, they gap. That's what happened in 1929. That's what happened in 2008. Today, interest rates rose faster than at any point in decades. Emergency banking programs were needed just to stop regional failures from spreading. Even the Treasury market, the most liquid market in the world, has shown signs of stress. The oxygen is leaving the room. Stage 5 is the trigger. This is the part nobody can predict. The trigger doesn't cause the crash, it reveals it. In 1929, it was a small foreign banking shop. In 2008, it was a single investment bank. This time, it could be geopolitical, financial, political, or something nobody is watching. When all 4 stages are active, the trigger usually follows within 1 to 2 years. That places the risk window squarely in 2025 or 2026. This doesn't mean a crash is tomorrow, and it doesn't mean panic. It means the pattern is visible, and ignoring it has never ended well. The people destroyed by crashes aren't stupid, they're unprepared. The signal isn't a headline, it's the pattern. And now you've seen it.